Hello out there in sales tax world. Welcome to today's webinar, Sales Tax 101 for Software, SaaS, and Digital Products. My name is Courtney. I'll be your host for today's session, and we have a great presentation lined up for you today. We are excited that you could join us. As I'm sure you all know, the taxability of software has been a hot topic discussion lately as states continue to define what is and isn't taxable. Today, we have our software taxability expert, David Lingerfelt, joining us to help us understand the latest on software taxability rules and the importance of creating a compliance game plan for your business. Before we dive in, just a couple of housekeeping reminders. We are recording today's webinar, so if you'd like to listen to it again or even share the recording with a colleague, keep an eye on your email inboxes for that link, which we'll send out in the next 24 hours or so. And next, I wanted to review this orange webinar console that you're looking at and how you can interact with us today. So over on the left side of your screen, directly underneath the video feed, you'll notice there is a Q&A box. You can use that box at any time over the next hour to submit your questions for myself or our speaker. We will be responding to questions individually as we're able to through that Q&A box. And then we do have some extra time set aside for Q&A at the end of the presentation as well. So if you're able to stick around for that, I would definitely recommend it. There is also a community chat available on the console that you can use to interact or network with your fellow webinar attendees. If you'd like to check that out, there is an icon along the bottom of your screen that looks like text message bubbles. So go ahead and click on that, and that Q&A or the community pop up for you. You can also click on that same chat bubble icon to minimize that if it's too distracting during the webinar. But if you'd like to, go ahead and say hello and let folks know where you're from. You might find some other sales tax professionals that are near you. All right, going back to the console, we also have some related resources and links available if you're interested in learning more about any of the topics that we're covering today. That's also where you can download your own copy of today's slide deck if you'd like to save it for later or just use it to follow along today. All of those windows will open up in a new tab. So if you have any that you're interested in checking out, go ahead and click on them now, and they'll open up in a new tab and be waiting for you when the webinar is over so you don't miss out on anything. And then new to the console, I see a few of you have already been using it. We do have the ability for you to add reactions. So if you want to let us know what you're thinking, you'll notice there is a smiley face down at the bottom of the console. And then once you click on that, you can see some available reactions. All right, just one quick disclaimer to get out of the way first and foremost. Friendly reminder that Avalara cannot provide legal tax advice. Everything that we discussed today is for educational purposes only. But as always, we'll do our best to answer questions as best we can. But that is something to keep in mind as you're submitting questions. Please try to keep them as broad as possible. If they get too specific, that's unfortunately something that we're not going to be able to answer. And today we are also offering 1 hour of CPE credit for today's presentation. For those looking to receive CPE credit today, please note that we'll ask you to respond to 3 out of 4 poll questions. The poll questions will pop up and appear in the same window that the slides are appearing in now, so they're easy to see. Make sure that you are ready to answer those questions as they appear. They will show up for a limited amount of time. So keep an eye on that. And then in order to qualify for CPE, you must also attend today's session for at least 50 minutes. So keep that in mind as well. Once you've met the CPE requirements, your certificate will be available to download in the Earn Certification box on the console. And then you will also have access to it in a follow-up email that's sent out. So if you miss it today, don't worry, it's still there. All right, let's meet today's presenter. So as I mentioned, we have David Lingerfelt joining us. He is Senior Director of Indirect Tax at Avalara. I've had the pleasure of working with David on several webinars in the past. It's always great to have him back. David, welcome.
Thank you, Courtney. I'm glad to be here. Looking forward to today's conversation.
It's going to be a good one. Yeah. All right, just a couple more slides for me. Wanted to review the agenda. So we're going to kick off today with why compliance matters for software and digital goods providers. Next, we'll look at Nexus and how software companies can trigger Nexus. Then we'll dive into some software taxability examples and considerations to keep in mind Then at the end, we'll wrap things up with game plans for growth. But before I pass it over to David, we do have our first CPE poll question appearing on the screen now. So which of the following products or services does your business sell? And you are able to select more than one if your business sells more than one. So we have a few different options. And if none of those fit with you, just pick the one that best aligns with what your business sells. And if one is outside of that box, let us know in the chat box. So we have software that's offered on physical media, software that's electronically downloaded, software as a service or SaaS, digital products, which could be something like content downloads, etc. Or maybe you're not even selling digital products or services and you're just thinking about it and you're here to learn. So we have an option for that as well. We'll give folks a couple of seconds to answer and then I will pass it off to David. All right, couple more seconds. Get in your selections now. All right, let's go ahead and look at our results. So let me scroll through this. It looks like the majority of people who responded to the poll are selling software as a service, followed by software that's electronically downloaded. And then we do have a few folks that are thinking about selling it in the future, but not currently. So that's great that you're learning about it now. But thank you everyone for responding to those. And David, I'm going to stop talking and pass the mic over to you.
All right, thank you. Good morning, everybody. I'm glad to be here today. So why does tax compliance matter for software and digital products? That's our theme as we start this journey together today. So really at the base of everything is the tax landscape's constantly shifting. The rules change, the regulations change. So that means new obligations for you. As the use of software, SaaS, digital products grows, so does the number of states seeking to tax them. So state tax policy is usually shaped by where the revenue is going. So failing to recognize taxability updates can cause you wasted time and resources. It can result in error-prone filings. Both of those are going to end up in a very negative place, which is you've got an audit, fine, and penalty. And at that point, it's quite painful to remedy that situation when you're working through audit and trying to resolve audit issues. And the fines, the penalties, the interest can often exceed the tax by multiples. And so it's not a pleasant scenario. So what's critical to understand is, do you owe sales tax? And when you begin to inquire or have about that, your first question that you have to answer is, do you have nexus in the particular jurisdiction? So what is nexus, right? So nexus is all about where do you sell your products or services or software or digital goods, the who you are selling them to, and the what are you selling. So you have to think in that framework when you're answering the question of, do I have nexus? Where is it being sold? Who am I selling it to? And what specifically am I selling that to? So when you're thinking about intangible product, the where gets really large very quickly. The who gets very nebulous. And the what also is a little bit more difficult to define when you think about an intangible product or service. So it all comes down again to, do those three combinations trigger nexus? And nexus is a legal term that basically means, do you have sufficient connection between you, the seller, and the taxing jurisdiction, which is the state or the local level entity or the federal government or the government, if you're talking about international taxation? Is there sufficient connection between you, the seller, and that taxing jurisdiction? And once that connection is established, then the long arm of the jurisdiction, so to speak, can reach out and grab you and say, you now have sufficient connection to us that you must abide by our tax rules and regulations. There are two really critical types of nexus that we want to talk about. But before I talk about those, I want to talk about some precursor concepts. So physical nexus has always been around. It was the law of the land pre the Wayfair Supreme Court ruling in 2018. As the world around us changed, it became very evident very quickly to taxing authorities that physical nexus was causing them to lose significant revenue. And so states started to get creative in their response to how to push the boundaries of the physical nexus limitation. So you will hear, and they're still around, just not as prominent anymore, other nexus concepts such as affiliate nexus, which is when an out-of-state business can create nexus through its in-state affiliates. So it has relationships with its separate legal entities, and those relationships can cause the parent to stand in the place of the affiliate and have nexus. And you also have a concept called click-through nexus, which is maybe you're blogging. Maybe blogging is really big these days, right? You're on YouTube and you do YouTube videos and you're rating a particular product, and down at the bottom is a link to Amazon where you can purchase that product, a referral link. And when you click on that, because that blogger, let's say, is in the state of North Carolina and they're referring you to Amazon, the theory was Amazon now has nexus by way of that click-through or that referral with the individual who had a physical presence in the state. Those are older concepts now. The predominant concepts around nexus when we think about sales tax is still physical nexus. It's absolutely a thing. Even after Wayfair, physical nexus will entrap you. And it's basically you have a physical presence in the state, either through production, offices, warehouse, remote employees, or salespeople visiting the state can also trigger this concept or physical nexus. And then now the post-Wayfair law of the land is economic nexus, which says the long arm of the state can grab you because you have sufficient nexus through economic activity within the state's jurisdictional boundaries. So you either satisfy that through a gross receipts or transactional activity. For example, you sell 100,000 widgets into the state during a given period of time, or you sell gross sales in excess of $250,000 in a given period of time. You have now triggered the nexus in that particular jurisdiction. All right, nexus thresholds by state. This is sort of a visual to help you see the landscape. It's current through, I believe, September, late September. And what you can see is the variation in thresholds. There are both dollar thresholds, 500,000, 250. You'll see a few states still have the dollar and transactional thresholds. But as we move further away from Wayfair, many states are starting to drop the transactional threshold, and they're really looking at the dollar threshold and focusing on that. And you can see those variations and flavors across the different states by looking at the heat map on the right. Connecticut's threshold, as you know, an example, they do have an and, which is a conjunctive test. You have to satisfy both. They're a bit of an anomaly in today's current landscape. So it's $100,000 and 200 retail transactions. New York also has a similar and threshold, but their dollar is higher and their number is lower. And again, we continue to see states tweaking this and dropping their transactional thresholds in favor of a specific dollar threshold. And of course, Avalara has a free sales tax risk assessment that's available for folks to leverage to determine, where they may have triggered nexus and was unaware. So feel free to leverage that resource. I just saw a question pop in. I'm going to back up for a moment and just take the question because it's relevant. It says, what if the gross receipts are all non-taxable? So, or they are not taxable services in that state, or the customer's tax exempt. So the question, calls out a particular anomaly in this space, which is the threshold for what's included in, or not the threshold, but the definition of what's included in the gross revenue amount varies from state to state. Some states include exempt receipts. Some states exclude exempt receipts. Some states include some types of exempt receipts and not others. So the devil's in the detail, as they say. You really do have to familiarize yourself more deeply with the specific requirements around what satisfies that revenue number in any given state. All right, moving on. What are some common triggers for software companies? So when you think about software, many of the activities you do in building software, deploying features and functionality in new products, improving your architecture, all of those types of things can trigger Nexus. So for example, migrating to the cloud absolutely can trigger Nexus because suddenly you can now sell the software anywhere. New sales channels. So if you're going online sales or direct to consumer, again, you're moving perhaps from B2B or business to business to consumers. That has different implications in different jurisdictions in terms of economic nexus. If you're adding remote employees, visiting customers, or opening new locations, you absolutely could trigger Nexus. In the post-Wayfair world, so I encounter that, occasionally that some people have sort of forgotten about physical Nexus, but it is absolutely real and present and will be the fastest way for you to create Nexus if you have any of these particular situations. Remote sales, so if you're downloading information remotely, of course you could trigger, depending on the type of the download and the jurisdiction, you could trigger Nexus this way. And launching new products or services always has the potential to create a new customer base in new jurisdictions, thereby creating Nexus. There's a question that's relevant to this topic that's also just popped in. The question is, how long do you have Nexus for? Once you gain Nexus, do you have Nexus forever? The answer is no. Nexus is the concept of you have sufficient contact with the jurisdiction so that they can reach out, literally and metaphorically reach out and grab you and say, you have to abide by our rules when it comes to tax. If those connections are severed, if you no longer have customers there, if your connection was through physical presence and you close the office there and your employees are now all in another state or jurisdiction, those things can sever Nexus with a particular jurisdiction. So creating it doesn't mean it lasts into perpetuity because the foundation is based on you having the appropriate level of connection with the state. All right, moving forward, we have a poll question. Courtney, over to you.
Yes, we do. Our second poll question. So now that we've talked about Nexus and explained a little bit about what it is and what can trigger Nexus in a state, we're curious, how many states does your business have sales tax Nexus in? We have a few different responses. This one, you can only select the one that best fits your situation. So 1 to 10 states, 11 to 20 states, 21 plus states, or maybe you don't know and you need to find out. Let's see, I'm going through the Q&A. There was one question I saw. Oh, does the 200 count transaction threshold for Nexus apply to downloads? Do you know the answer to that, David?
It, again, varies from jurisdiction to jurisdiction, but most jurisdictions that tax software would consider that download to be a transaction. Yes.
Got it. Okay. And then is the threshold for annual sales, and does it reset every year?
There is always in all jurisdictions, there is what is referred to as a look back period. And generally it is a calendar year, or it can be a fiscal year depending on how the statute is written, but generally it's a look back period saying over period X, let's say December 31st through November 30th, is the look back period in our jurisdiction. And if you exceeded that during that period of time, you now have nexus. So there's always a defined look back period.
Perfect, thank you. And then maybe one last question I just saw pop in. This person says, regarding the end of nexus, most states seem to dictate that in a year you must pass, oh, sorry, I'm looking at the wrong one. So this one says, regarding the end of nexus, most states seem to dictate that a year must pass in which sales are below the threshold to end nexus. Do you have any commentary on that?
Yeah, I don't know if I would agree with the word dictate. There's generally, the look back period, right? So if you walk in, let's say you've had nexus, and then you say, oh, next month, oh, I don't have nexus anymore, right? I'm not going to file your taxes. That's going to be looked at suspiciously. And when I was an auditor, I would have looked at that suspiciously, right? It's always a test of, in the ordinary course of business, is this practical and does this make sense? And in some cases, that may absolutely make sense. If your connection was physical, not economic, and you literally close the office down and you can demonstrate to the state that the office no longer exists as of date X, then the nexus is severed, right? And you don't need to wait a year. If your nexus is economic, then it becomes a little more questionable, because you just think about the practicality of that. Okay, you met it in the previous year, and now you're telling me 2 months later, I'm not going to meet it in this coming year. Well, how do you know that with certainty, right? So then it becomes a little bit more tenuous of an exercise to demonstrate that you truly have severed that economic nexus. So generally the period of time is a little bit longer, because you have to think of it through, is that practical in the ordinary course of business?
Got it. Okay. All right. Wonderful. Thank you for that. All right. Let's take a look at our poll results here. So not surprisingly, over half of you have said that you have triggered economic or sales tax nexus, I should say, in more than 21 states. And given the economic nexus thresholds, that's not too surprising. We have 22% that are in 1 to 10 states, 21% in 11 to 20, and then 5% of you don't know but need to find out. So hopefully this is giving you some information to chew on.
Absolutely.
All right, David, back over to you to talk about some examples and challenges.
All right. Yes. So there are many challenges when we think about taxability of software. And we'll start with just sort of a framework, if you will, of factors that impact the taxability. So generally, we need to understand what type of software or technology are we dealing with, right? So we need to label it, for lack of a better word. Is this software as a service? Is this digitally downloaded? Is this platform as a service? There's all kinds of as a service models there that this could be. So you really need to understand and label the technology. And another consideration is, how is this delivered, right? How do you actually access? How do you transfer the product? Right? Do I need to come pull it down off of a server somewhere and digitally download it? Do I still buy a physical, device or thumb drive to add it to my desktop? Do I access it remotely from, a server somewhere, anywhere in the world in the cloud? So delivery method is important. A third characteristic is, do I receive permanent or temporary rights of use to this particular digital product software? And of key importance and often overlooked is, how do you yourself describe the product in your legal documents, on your invoice, in your marketing materials? This one is of particular importance because I used to be an auditor a long time ago. And one of the things that I just found interesting is that, the tax department, for example, would take a specific position that they were selling software that's downloaded. I'm like, okay, this is okay. And they didn't tax it for that reason because this particular jurisdiction didn't tax that. But then I go to the language the actual company uses in its marketing materials and its T's and C's or terms and conditions. That is not at all how the product is described. It's described as software as a service. So when you have this internal conflict, you're a target for an audit. So it's really important that the way that you frame and describe and think about your product is the same way you talk about it to the rest of the world. And just this, important little note here, 45 states have some form of sales tax on software. Of course, the 5 nomad states have no sales tax. And the consistency is, not there. There's lack of consistency. It's all over the place. So you think about the framework, what are the factors, and then what are the various methods in which tax is actually attached to a software. So one way that it can be done is the sale of TPP, or, for example, in the state of Arizona, they consider it the rental of TPP. So it can be the sale or rental of a tangible personal property is one method of taxation. The sale of a service, it can be, characterized by a state as the sale of a service. So it can be data processing services or computer services. Or the state can take a third approach and expressly enumerate within their legislation that, the definition of SaaS or the definition of remotely accessed software or the specific definition of digital goods and what is included within that definition. So those are the various methods for states to actually attach tax or to attach an exemption to a specific piece of software. All right. Here's a heat map, again, that demonstrates it was specific to SaaS. So we're talking about software as a service. It demonstrates just the various approaches that states are taking to taxability. So the first thing is you can see that some states tax at their general rate, and you see those in orange. Then you can see many other states that are exempting SaaS, and you'll see those in the darker shade of blue. Then we have Maryland, who has taken, created a specific rate for digital products. And so they have the 6% rate. Then you have Hawaii that generally taxes most everything at its 4% rate. Then you have Texas that's taken a different approach and said that, SaaS is data processing services, and they tax 80% of the sell price of the data processing service. And then you have the nomad states. So you have all kinds of flavors of this. Arizona, I believe I jumped Arizona. Arizona treats that, again, as the rental of tangible personal property, and it's taxing it at 5.6%. All right. We will move forward. How software is taxed. So we have a couple different flavors of software. We talked about the framework in the previous slide. So up here you can see, let me see if I can move the little emoji so I can see this. You have canned software delivered on physical media. This is the equivalent of TPP in every jurisdiction, but for the nomad states will tax this form of software. Then to the right, top corner, you have canned software that is electronically downloaded. So physical media versus electronic download, and you start to see the colors on the map change. So you have a variety of states that are exempting it and some other states that are still taxing that form of software. And then you come down to the lower left quadrant and you see lots of blue because this type of software is canned software that has been customized, specific to a client. So once customization becomes involved, There are many, many states that will exempt that, and far fewer that will tax that. So you'll see the map change quite a bit. And then finally, you see the software as a service in the lower right quadrant, which is what we just discussed. It's the same map. All right. What is taxed versus what's not taxed is counterintuitive. So what do we mean by that? So for example, we talked about web-based software or SaaS, if you will. It's taxed in 18 states. It's partially taxed in Texas, as we saw. They tax 80% of the base. And then you have the anomalous treatment in Connecticut, for example, where you have B2B software. So if you sell SaaS from business to business, you get a preferential tax treatment of 1% versus the full rate. Then if, let's say you sell something like a digital photo. I think most of us who've been involved in sales tax for any period of time would understand that a photo that I went and purchased, at brick and mortar or off Amazon to put on, artwork for my wall, that's going to be subject to sales tax. So why wouldn't digital photography? I mean, logic says, well, it's the same thing, just in pixels in a digital form, right? That's what logic says, but that's not what reality is. So generally, it's only taxed in 23 states today, and Puerto Rico, which is a U.S. territory. If it's attached with the sale of advertising services, the taxability slightly changes again, and you have a few more states that will tax that than treat it exempt. So that little characteristic of attaching that digital photography with advertising services flips the taxability. Another great example, a digital movie, right? We all know that years ago we had Blockbuster. I think the very last one may be finally closed. I think it was somewhere in Alaska. But you paid sales tax on that rental in states that had subjected that to tax. So the logic would say, well, in the digital movie, the same thing, right? But again, logic breaks down because not all states treat it that way. So there are 29 states that tax digital movies. Let's think about streaming. So it's slightly different from a download of a digital movie. When you think about streaming video programming, then we only see taxation in 25 states. And here I'm talking specifically about sales tax. So when you get into streaming, you also open the can of worms called telecom taxes. And those are numerous and just as varied as sales tax. And another great example is software training. So when you're in the world of software, you will often have training that's associated with the sale of your software. It can be on-premise, right? If the training occurs on-premise, then that typically is taxed in at least 9 jurisdictions. If the training is not associated with the sale of the software itself, meaning the training is optional, then it's only taxed in 6 states. So there's all of these little nuances in this space about how the transaction occurs, whether it's optional or mandatory, whether it's in-premise or not. The delivery method, as we talked about with software, the same is true for training. All of these things that can come into play to drive taxability. So it's not, it can be counterintuitive. It's not logical, as we pointed out. All right, here are a few updates that are noteworthy this year in taxation of software and digital goods. So Georgia, effective January 1st, are subjecting digital products to sales tax when the end user receives the right of permanent use. So here's that piece that we talked about earlier, the difference between permanent use and not permanent use. So this is coming into play in Georgia. Vermont enacted a new bill to include pre-written computer software, such as SaaS, in the definition of taxable TPP. And that was effective July 1 of this year. So keep in mind, they chose to extend tax by way of TPP. So they expressly modified their definition, one of the ways that we talked about in the previous slide. New York had two recent rulings that solidified or reinforced the state's stance that bundles that include TPP and software licenses are taxable. Michigan added some guidance on the taxability of NFTs. So this is a particular interest of mine. So I want to take a moment to explain, you all. An NFT is basically a digital identifier. And what it does is it certifies authenticity and ownership of an asset on the blockchain, which is immutable. You can't change the blockchain because it's shrouded in cryptography. But the asset that it represents, the NFT, is the authenticator or the indicator of authenticity and ownership, right? But the asset it's tied to can be digital or physical. And this is really important distinction, because in this case, Michigan is saying, if it represents ownership interest in TPP, it's taxable. So they're making an important tax decision based on that distinction. An example can be Nike, for example, has sold a NFT for their shoes, some of their very expensive, exclusive, one-of-a-kind shoes. It shows that they're authentic and that you own them, and that's represented on the blockchain and cannot be modified. But the shoe is physical, like you can touch and feel it and put it on your feet, right? And in the case of Michigan, that would be taxable. You can also have a digital, so you have an avatar in Decentraland, and you can buy digital shoes to put on your avatar, name brand digital shoes, right? Those are digital. They're not physical. They could be stored on the chain or off the chain itself. They could be, somewhere in another remote server and not necessarily on the blockchain. But the point is, it's a digital asset. And so in the case of Michigan, that would not be taxable because it is not tangible personal property. And then finally, we have Texas. Auditors have applied a specific administrative rule in Texas, which is 3.330, which requires data processing providers to collect tax on charges for data processing services, right? This has long been Texas's position. This is just another reinforcement of that particular concept around tax. All right, a poll question, Courtney, over to you.
Yep, our third poll question here. So this is our 3 out of 4. We will have one more a little bit later in the presentation. But for this one, we're curious, how automated are your tax compliance processes? It would mean that you've automated almost everything and you're doing great in automation world. And a 1 would be you haven't really automated much of anything and have a lot of work to do. So we'll leave this up for a few seconds again. There was a really interesting question that came in, David, that talked about sourcing. So I think this person was saying that when they're selling software, typically they don't know where the end user is located. They just have maybe their credit card zip code or credit card address. Can you talk a little bit about how to apply sourcing when you don't have that kind of information available?
Yeah, there's a little call out in a slide or two coming up, but I'll talk about it more now. Sourcing is really challenging in the digital space. And typically, when you purchase something from an online retailer, physical TPP, they must collect from you a delivery address. How else are you going to get the product, right? So they know exactly where they sent the product. So sourcing is fairly easy in that scenario. When you are selling software, you maybe don't even collect a full address because you don't necessarily need it. What you need is information to appropriately bill the customer, And maybe you collect a billing address, which includes a street level address, and maybe you don't. Maybe all you collect is a credit card number and a zip code tied to the credit card. In cases like that, the concept around sourcing basically says, source it to the address that you have for the customer maintained in the ordinary business records, right? So let's say you have in the ordinary business records a bill to address. Then that would be the address that you would source it to. There's also this concept, Washington State's really good about this. They have this, additional prong that says where the digital product or software was first accessed. Now, again, I use this example often, my Netflix subscription, right? Well, I accessed that movie that I was watching somewhere over the Canada tundra when I was flying back from Canada to RDU. So, that's really hard to demonstrate where you first accessed it, right? So again, you would fall back to what address do you maintain in the ordinary course of business? And maybe the only address that you have for that customer is a zip code tied to their credit card or debit card that you got to actually bill them for their subscription. And in that case, you would fall back to the zip code. It's not a perfect representation of accurate tax because zip code is for postal delivery routes, not for tax. And so it could cover multiple taxing jurisdictions, but it is a practical way to do it. And if you're an auditor, how are you going to prove where it was actually accessed, right? If you don't store the URL, or not the URL, the actual server location that was pinged, which I don't know of any ERP that does that in the States, and all you have is a zip code or a bill to address, that's how you're going to source because you have no other option. Hopefully that helped, Courtney.
Yeah, thank you so much for diving into that. Yep. All right, let's finish up with our poll question here. Take a look at the results. So it looks like the majority of people are kind of in the middle. They've automated some things, but there's room for improvement. Over 20% said that you've automated almost everything. So I think that that's something that more and more businesses are going to have to do if they want to stay up in today's world. So again, thank you everyone for responding to our poll question. That was 3 out of 4. We will have one more that appears at the end of the presentation. So if you missed one, stick around for that. And David, back over to you.
Yeah, I have this really good question I want to touch for a minute. So I believe there's a question in here that says, what background do the auditors have? Is there more information on how to categorize software? As an IT professional, I have difficulty categorizing my own software. Here's what I will tell you. When I was an auditor, the World Wide Web was powerful. I did so much digging on any company that I had selected for audit. And the biggest source of information out there is, first thing I would do is go to the company website and say, what are their terms and conditions? Most companies put their terms and conditions right out there, right? And I read them word for word. What did the legal team say about this product? That was always my starting point. And then, every company I know of that sells a product then has all this marketing material out there. And I'm like, okay, what does the marketing material say about this product? Does it align with the T's and C's, or are there discrepancies? And if there are discrepancies, then I start with my question, my first survey that I would send out to the particular audit candidate to answer these questions, right? Because I'm trying to resolve the discrepancies, right? And then I would often just look at, Reddit and other forums where they the customers talk about the products. How are they talking about the products and how they use them, right? So there's just a wealth of information out there that empowers auditors to have a ton of information about your business when they walk in that door. They often know more about the products and services than the tax team does, and that puts the tax department at a disadvantage right away. All right, that was a very good question, so I want to take a moment to address that. What are some further considerations, challenges in the US and Canada? So in the US, you have this multi-tax jurisdiction issue. And that's why I alluded earlier that zip codes aren't a perfect answer, but it may be the practical answer. Because in the US, we have not only state level taxation, but we have local level taxation. Cities and counties will and can have taxes, and something called special taxing jurisdictions, which is not a government unit, but a artificially drawn boundary for the application of tax. So all of these layers can come in to give you a combined tax rate. Those layers aren't represented by a zip code, right? The zip code can fall in the wrong set of layers. And so that makes it particularly challenging when you're in urban areas in the US. Large cities will have very, very dense layers in which, there's intersections of these different interactions between the jurisdictions. So it can get very complicated. There's no great way to do that unless you have an automated solution that can geolocate precisely where the transaction is occurring. Some states have various taxability rules. Again, we talked about the variation in how states define and attach tax to digital products and softwares. And then the sourcing definitions, which we just jumped into. You have these sourcing concepts, brick and mortar transactions with TPP, or e-commerce transactions with EPP or TPP are quite easy. You generally source it to the destination where it was delivered or picked up, right? Those are easy. When you're in the world of digital, it is not very easy because generally the concept is where that digital product was first accessed or where the customer address is maintained in the ordinary course of business. In Canada, you have GST, HST, PST all interacting to determine taxability within Canada. So they have a quasi VAT-like scheme, but it also has attributes of sales tax. It's a mixed scheme, if you will, which adds some complexity there. And then they just enacted or are enforcing, not just enacted, they're starting to enforce their digital services tax, which requires foreign and domestic companies to pay tax on certain revenue earned from engaging with online users in Canada. This concept is mostly applicable to really large commerce companies that do a lot of advertising, i.e. Facebook, i.e. Google. It really is targeting these large companies. It is a concept designed to more equitably distribute tax to the jurisdiction where these platforms are targeting customers and benefiting from those interactions. It's in response to the G20 not being able to reach consensus around some of the Pillar 1 and Pillar 2 provisions in OECD framework for dealing with this. So that's a lot of information, a lot of new concepts, but it really does apply to very large commerce platforms. So if you want to know more about that, if you think that you fall into that bucket, I would encourage you to do a little additional research around that. Let me just a second here. My screen is misbehaving. There we go. All right, challenges in the EU. So when you are in the software and digital space, the challenges are much bigger than North America. So the application of that to software depends on the type of software and the location of the transaction. That's not too dissimilar from North America. But what's critically important is that there is no equivalent concept of economic nexus for non-EU sellers. So put another way, there's no de minimis threshold for VAT on digital services when the supplier is non-EU. So when you start selling into the EU and you are a non-EU based company and you're selling your digital services, then you must register and collect the VAT as soon as you make the sale. So that adds to the additional complexity that is in the space. All right, we're going to pivot now to game plans for growth. So almost every software company and digital services company, generally they have a plan for growing, right? They want to grow. If they're an early stage startup, they want to grow so that, as part of their exit strategy, they either go IPO or be acquired, but there's always a growth strategy. So what does that mean for your particular tax? How do you think about growth and how do you plan for it, all right? So do not let compliance take a back seat. I know that's easy for me to say. In reality, it's probably a little harder for those of you embedded within your organizations. But you do want to stay aware of changing taxability rules. You do want to get ahead of issues caused by growth. So the more you sell online, enter new markets, expand physically, become part of M&A activity, all of those things can trigger nexus and sales tax implications. You want to keep top of mind, compliance top of mind, even though it's often considered a back office function. And you really want to examine big changes so that you understand how they are impacting your tax footprint. The more you do that, the more prepared you are. What you do not want to do is have, sales tax deficiencies show up in the due diligence process as part of M&A activity, because that can be unpleasant. And those have to be resolved, and they get resolved in a variety of ways. But needless to say, that is generally not the way that you want to discover that you have a sales tax compliance issue. All right, let's see. Here we go. So one way you can do this is acquire or purchase a tax compliance automation solution. And Avalara, in my opinion, I'm wearing the orange, so I'm not unbiased here, but I think we have a great solution that offers end-to-end tax compliance journey to help our customers. My screen is acting up again. Sorry about that. So we start with tax research. We do have a tax research product that allows you to dig into the actual statutes and regulations and get tax answers around very specific tax questions that are unique to your business. And then we have an exemption certificate management system. So it's very critical that you manage exemptions, that you have documentation for any non-statutory exemptions that you are giving to customers. So if they say, I'm using this, for R&D or whatever the reason may be, and that requires you to obtain a properly executed exemption certificate, if that's not accessible to you during an audit, then it's like it never happened, and you will have to pay the tax on behalf of the customer. And then that also exemption certificate management system also interacts with our tax determination engine, which is where we keep all of the taxability rules and applicable rates current for the software and digital products industries. And that tax determination engine is natively embedded in many ERP, e-commerce, and point of sale billing platforms where the invoices are created. And then finally, we have the sales tax return solution, which is also integrated with our tax determination engine. So once your transactions are committed and saved within the engine, they can then be automatically transferred into our sales tax platform, where a return can be generated and submitted to the authority timely and correctly. All right, last poll question, I believe, Courtney, over to you.
Yep, that's right. Question 4 out of 4. And thank you, David, for going through all of this great information. So we'll leave this last poll question up on the slide for a few minutes. But just if you would like a follow-up from an Avalara sales representative, go ahead and select yes. If you'd like to learn more about the solutions that we offer, just get in touch. to learn more about automation and see if it might be right for you. But like I said, we'll leave this up on the slide or on the screen while we start digging into questions. And there have been a lot of questions coming in, so thank you everyone for being engaged. One question I saw near the beginning, there were some questions around use tax when it comes to software. We don't have a slide on that, but David, I wondered if you could maybe share some key takeaways if you have any.
Yeah, I think the way that it comes up often in this space is twofold. Software companies themselves use a lot of software, because you do what you do well, and then you may use software for back office functions and other things, or subscriptions that become a part of your actual product. And so that is where use tax can come into play in this space. You may have a use tax obligation if you are purchasing yourself software to use in your business and you were not appropriately charged tax on that. You will be liable for consumer's use tax. That's one use case. The other use case is where I think the state of Washington has this, where you may purchase, for example, a subscription, a SaaS subscription that your particular employees use, right? And it's billed to, maybe you're headquartered in the state of Washington and they bill you in the state of Washington. And then, there isn't tax applied for whatever reason, but your users are scattered all over the US. Maybe you have 10 in North Carolina, 5 in Florida, right? So you have this concept of multi-use tax where you can distribute the usage and apply the use tax according to where it's actually used. So there's that concept. A few states have that, not all states, but that's how it typically shows up in this space.
Great, thank you. I saw another question come in recently. How do we determine the correct tax code for our products? And I think that the simple solution would be use Avalara. I'm assuming they are not using Avalara yet. So what recommendations would you have for non-Avalara customers to find the right tax codes?
I'm not sure what the customer's using. We do refer to our internal codes as tax codes, but generally whatever system you are using, if you're purchasing a tax automation solution, you will go through a mapping exercise. There's no other way this can be done, where you take your products and services that you sell and you map them to their proprietary designation that represents that product or service. We call them Avalara tax codes. I'm not sure what all the competitors in the space call them, but the concept is the same. And you can't hope to do that well, from my point of view, unless you have good command of what your product or service actually is, right? Because you will not go to anyone, whether it's Avalara or anyone else, and find a tax code that exactly specifies, oh, yes, this is exactly what my product is, right? Because what is done in the tax automation world is genericizing. And what I mean by that is a tax code or its equivalent's only created when there is a tax distinction that needs to be made. It's not created to represent a one-to-one relationship between seller's inventory or seller's product and service list, right? Because if there isn't a tax distinction to be made, then the general code for TPP is good enough. And so I think I would always encourage people to start with a deep understanding of exactly what their product or service is, because that's the only way they're going to be sure that they were getting the correct tax code. And then once you think you have the correct tax code, then generate a taxability matrix for that code from your provider to make sure you're seeing taxability behavior that you would expect before you select that code. That's the best defense, in my opinion.
Thanks, David. Yeah. All right. Well, we are right at the top of the hour. I know we had a ton of other great questions that came in. We could spend, I think, 3 or 4 hours just answering questions. and they would never end. So we have kept note and record of the questions that have been submitted. So if we did not get a chance to respond to your question, we will do our best to get you the information that you're looking for post-webinar. Give us a little bit of time to get through all of the questions. Final reminder, if you would like to talk to an Avalara sales representative about automation, like David was saying, that really is going to be your best bet in terms of making sure that you are looking at the correct tax codes, applying the right tax rates. Go ahead and select yes to that poll question, and someone will get in touch with you as soon as possible. And then just a couple of final reminders. If you did qualify for CPE credit, you should be able to download your individual certificate in that Earn Certification box that's underneath the additional resources. So make sure you do that. Like I said at the beginning, we'll also include a link to your certificate in the post-webinar email that will be sent out. So if you don't get it today, that's okay. Just keep an eye out for it in your email. And then I also wanted to do a shameless promotion for Avalara Crush, which is coming up on November 11th through 14. This year, it's going to be in Austin, Texas. This is our big customer conference that's held annually. I think it's taken a few iterations since COVID, and now we are back once annually. David, I think you might be there. And I know a lot of our other presenters that I work with are going to be there. So it really is your opportunity to not only connect with other Avalara customers, see what other customers are finding challenging, how they're overcoming these challenges, but then also connect with some of our Avalara sales tax experts one-on-one. So great opportunity to do that. There's a link to that in the additional resources section. It's avalaracrush.com if you're interested in learning more. And I think that's everything. David, thank you again so much for sharing all of your expertise. This was really informative, and I hope that our attendees found it valuable as well. Any final thoughts from you before we log off?
No, thanks for everyone's attention and the great questions today, and good luck on your sales tax journey. Hopefully Avalara can help you along your journey. If not now, at some point in the future.
Yep, absolutely. All right, everyone. Well, thank you again for attending. We will see you again, hopefully very soon, for one of our next webinars. Have a great day.
Bye-bye.